Kamakodi. Thank you for joining us on ET now. Could you talk to us about the quarter gone by, the Q2? How did it actually pan out for your company, for your bank in particular, and how is the asset quality?
In fact, after the COVID started, somewhere with the fourth quarter results of financial year 1920, we suggested that things will be getting back slowly to normalcy from the second half of financial year 2021, and we should be getting back to the pre-COVID ROA of 1.5 from the second half of financial year 22-23. So that same thing was getting reiterated again and again along with the fourth quarter results of financial year 2021 and also the first quarter results of financial year 21-22. In the same line, as we had been stressing right from the beginning, we are not pressing the growth pedal. At the same time, trying to ensure that, like say, the growth comes through the gold loan. At the same time, there are issues with the recovery of NPA because it was getting delayed because the legal system was more sympathetic towards defaulter because of the pandemic and all. Slowly things were improving. In the second quarter, the slippage also reduced to greater extent, and also the recovery also improved. So the highlight of the second quarter is that we could record a growth of about 7% in the credit, along with the reduction in the slippage and improvement in the recovery, giving us confidence that we should be, things should be improving as we move forward. Maybe the growth should be back towards the end of the current financial year.
Mr. Kamakodi, this is Vinny as well joining in. If you could actually give us an understanding on the NII growth. Now, when I'm looking at it, it has been a bit low when I look at it on a YOY basis. So talk to us about that, and do you see the growth on this front going forward?
Basically, what has happened is that after the onset of the pandemic, like say earlier, we used to operate the system with about in the credit deposit ratio in the north of like say 85, 86, 87%, which now because of the pandemic situation, we have to operate on the surplus liquidity with about between 80 to 82. Along with that, since our entire loan book is on floating, whenever we are getting into the reducing interest rate scenario, the margins used to contract, and whenever we get into the increasing interest rate scenario, margins used to expand. Even in that, like say, you could have also seen some improvement in the CASA percentage and all. There is definitely, because of the surplus liquidity and the monetary transmission, the yield reduction is there. To a greater extent, it has been offset by the advantages got in the cost side also. That's why we could record about marginal increase in the net interest income. In fact, if you had seen in the Q1, the net interest margin, in fact, had reduced below 3.9, which has come back to like say 4% plus. Normally, if you had a chance to look into our net interest margin for the past 50 to 60 quarters, we used to roughly operate about 80% of the time between 3.4 and 3.7. For the last 7-8 quarters, except 1 or 2 quarters, we had been operating above 4%, and now also it is holding, net interest margin is holding above 4%.
Right, Mr. Kamakodi, and talking about your NIMs, if you look at them, they are actually sharply down when I actually take a look at it since FY18 onwards. So where do you see NIMs actually stabilizing going ahead?
See, as I told you, out of the last 50-60 quarters, about 80% of the time we had stabilized only between 3.4 and 3.7. Now itself, it is operating above our established zone. So our current expectation is that it will stabilize around the same region, maybe between 3.9 to 4.2 or something like that for the foreseeable future. We are already operating the 4.2 and all, whatever we showed for 2-3 quarters in the past. I would rather, I won't see that as a steady state sustainable net interest margin, and the current level is something which is maybe current level plus or minus 20 basis point will be the sustainable range.
Okay, Mr. Kamakodi, thank you so much for joining in with us on the show. It's a pleasure having you on the show. And we're going to actually slip into a short break with that, so stay tuned in. We'll be back with more on the other side.